the bubble that fooled the world. It began with a rise so gentle, so steady, that no one questioned it. Prices climbed in quiet increments. Investors nodded with approval. Analysts praised the momentum. And before anyone realized what was happening, the calm ascent had turned into a global phenomenon. This story matters now because bubbles are never obvious until they burst. They grow from optimism, from hope, from the collective belief that this time is different. And in a world where money moves faster than ever, a small spark can inflate into a force powerful enough to reshape economies. To understand how seductive that illusion can be, we need to revisit the moment when millions believed the rise would never end. It started with a sector long overlooked, an industry dismissed by experts as slow, outdated, lacking innovation. But a handful of companies began posting unexpected growth. Their valuations crept upward. A new narrative emerged. Transformation, reinvention, disruption. Investors searched for the next big winner, pouring money into firms that had once struggled for attention. The early gains felt harmless, modest, rational, but momentum has a way of rewriting logic. Funds built positions. Retail traders joined the excitement. Financial media amplified the trend with glowing headlines. Price targets rose. Forecasts became euphoric. The story wasn't just about companies anymore. It was about a movement, a revolution, a future that seemed too bright to resist. As optimism spread, money flooded in. Every dip was met with buying. Every warning was dismissed as outdated thinking. The charts curved upward with a confidence that felt almost orchestrated. Investors stopped asking whether the valuations made sense. They only asked how high the next wave might go. But beneath the surface, subtle signs of imbalance emerged. Companies with weak earnings soared alongside genuine innovators. Firms with no profits raised billions overnight. Metrics that once grounded the market, cash flow, revenue, debt, faded from conversation. All that mattered was the story. And the early reveal was clear to anyone willing to look. Prices were drifting away from reality, carried upward by hope, belief, and the intoxicating promise of endless growth. Yet, almost no one wanted to see it, because when the world believes in a bubble, it doesn't feel like a bubble at all. The ascent accelerated as new money poured in from every corner of the market. Pension funds increased exposure. Hedge funds built aggressive positions. Retail traders arrived in waves, drawn by stories of overnight riches. The sector was no longer a quiet corner of the economy. It had become a global obsession. Valuations detached further from fundamentals. Companies with improving technologies saw their stock prices multiply. Startups barely a year old achieved billion-dollar listings. Analysts revised their models not because the data supported it, but because clients demanded justification for the relentless rise. The narrative had become self-fulfilling. These companies weren't just growing. They were inevitable. The reveal deepened when financial institutions created new products designed to capture the mania. Index funds, thematic ETFs, leveraged instruments, layers of exposure built upon the same soaring assets. Every new product attracted fresh demand, pushing prices higher and feeding the illusion that growth had no ceiling. Media outlets celebrated the boom as a generational transformation. Talk shows, newsletters, and social feeds turned the sector into a worldwide spectacle. But while excitement swelled, instability grew beneath it. Corporate earnings lagged far behind expectations. Debt levels climbed to fund expansion that produced little real output. Internal documents hinted at concerns. Supply shortages, weak margins, unrealistic forecasts. But those warnings stayed buried behind press releases glowing with optimism. The early conflict emerged when a respected economist issued a stark warning. He argued that the sector's valuations were unsustainable, that the fundamentals couldn't justify the staggering prices. Investors mocked him. Social media ridiculed him. Commentators dismissed him as out of touch. In bubbles, truth looks like negativity, and negativity becomes the enemy. Yet signs of strain multiplied. Insiders quietly sold shares at record levels. A large company delayed its product launch without explanation. Another revised its revenue projections downward. These cracks were small, but in a market built entirely on belief, even small cracks matter. Still, enthusiasm refused to fade. Traders bought every dip, convinced the boom would resume. Funds rebalanced to increase exposure. The world had fallen in love with the story, and stories rarely break gently. As momentum carried prices even higher, attention grew, barely visible but impossible to ignore for anyone watching closely. The bubble was expanding faster than ever, yet its surface had begun to tremble. And somewhere in the distance, the first hints of a coming reversal were beginning to form. The turning point arrived with a shock so subtle that most people missed it. A mid-sized company, one of the early stars of the boom, reported earnings that fell far short of expectations. Not disastrous, not catastrophic, just disappointing. Yet in a market held together by belief, disappointment can be explosive. The stock dropped sharply in after-hours trading. Analysts scrambled to interpret the numbers. Forums erupted with arguments. Some blamed supply issues, others blamed management. But beneath the noise, a deeper truth settled in. If one darling of the sector could stumble, maybe others could too. When the market opened the next morning, the reaction was immediate. Every company in the sector dipped, slightly at first, then faster as algorithms detected weakness. The first wave of selling triggered stops. The second wave triggered panic. Funds that had leveraged their positions suddenly faced margin calls. Retail investors watched in shock as prices slipped below levels they believed were untouchable. The conflict surged when a major firm delayed its financial report without explanation. That single act, an omission, a silence, sent fear slicing through the market. Traders interpreted it as a sign of trouble. Analysts warned of unreported losses. Hedge funds began quietly unwinding positions, not because they had proof of danger, but because they couldn't afford to be the last ones out. Liquidity thinned. Volatility spiked. Within hours, the once unbreakable sector spiraled into chaos. Then came the news that ignited a full-blown collapse. A flagship company, one of the icons of boom, admitted in a press conference that its projected growth had been overly optimistic. Its CEO tried to reassure investors, but the damage was done. The illusion cracked. The narrative faltered. The story that had carried billions upward now unraveled in seconds. Prices plunged. Algorithms sold. Retail investors flooded forums with disbelief, asking the same question again and again. How did this happen so fast? But the truth was harsh and simple. The bubble had never been built on earnings, outputs, or fundamentals. It had been built on confidence. And confidence, once shaken, becomes impossible to control. The contagion spread beyond the sector. Tech slumped. Consumer stocks faltered. Even unrelated industries saw a capital rush for safety. Funds unwound positions to cover losses. Banks tightened lending. The broader market trembled as the realization spread. The bubble wasn't a corner of the economy. It had woven itself into the global fabric. And yet, even as prices tumbled, millions of investors held on. They believed the rebound was coming. They believed the story wasn't over. They believed the dip was an opportunity. But belief couldn't stop the avalanche. It could only cushion the fall. The bubble had finally reached its moment of truth, the point where reality replaces hope and illusion gives way to gravity. The collapse reached its peak in a single, brutal session that traders would remember for years. Prices plunged from the opening bell, slipping through support levels that once seemed unbreakable. Charts bled red. Headlines screamed crisis. And the same voices that once celebrated the boom now asked how no one had seen the disaster forming in plain sight. The climax unfolded with a clarity that felt almost cruel. The sector wasn't just correcting, it was imploding. Market caps evaporated. Billion-dollar valuations shrank into irrelevance. Companies that had raised staggering sums of money only months earlier now faced bankruptcy. And as the sell-off accelerated, panic spread through every corner of global finance. Funds liquidated positions to meet redemptions. Lenders tightened their terms. Risk models fired off warnings that arrived too late to matter. Even strong companies, the ones with real earnings, real progress, real potential, saw their stocks collapse alongside the weakest players. The bubble didn't discriminate. It consumed everything. But after hours of chaos, the market finally slowed. Prices stopped falling. The avalanche settled into silence. And in that stillness, the resolution emerged not as triumph, but as reflection. Investors sifted through the rubble. Some had lost fortunes. Others had lost faith. Many stared at portfolios filled with numbers they barely recognized. Yet in the shock, a familiar lesson resurfaced. Bubbles don't burst because people stop believing in the future. They burst because people stop believing the story that carried them there. Modern relevance echoed through every conversation. In a world saturated with hype, narrative spread faster than analysis. Hopes grow louder than caution, and the line between innovation and illusion blurs until it disappears altogether. The next bubble may not look the same, may not rise the same, but will follow the same rhythm: optimism, acceleration, euphoria, doubt, collapse. And when it comes, the world will once again ask the same questions, the ones whispered through every boom and bust since the beginning of markets. So what do you think? Are we repeating the same mistake again?